Greetings and thank you for checking out Keystone TV. The fact that you're watching this video shows that you want to improve your financial situation and make better decisions with your money. Today we want to look at how miserable bond buyers are, and in particular long bond buyers. Now when you purchase a bond, there's a maturity date on it, right? Or a date to call or a date to maturity. Longer term bonds will provide higher interest rates. You'll get a higher yield. Shorter term bonds will provide lower because you're not letting them borrow the money for quite as long. Makes sense. Well, in a low interest rate environment like we're in right now, a historically low interest rate environment, many investors are not satisfied with the meager interest rates that they're receiving in shorter term bonds. So what do? They seek to go longer term on their bonds and maybe even go with a little bit lower credit quality rating that provides for higher interest as well. But here's why long bond buyers are miserable. Let me give you an illustration. Suppose, we'll call him Jeff, is out golfing with his buddies. Jeff's very happy in the knowledge that he's receiving an 8% yield on his bond. But over the course of the round, his friend Tim tells him that he just bought a bond for 10%. Well, interest rates have been rising, so it makes sense that Tim was able to go out later and get a 10% bond. Well, immediately following the round, Jeff calls up his broker and says, "Sell my 8% bond, I want one that pays 10%. Do it and do it now." At that instruction, the broker notifies Jeff that his current 8% bond is actually down 20%. So the $10,000 that he put into the bond, he'll only get it back if he wants to hold it all the way until maturity and continue only collecting 8%. His other option, sell the bond at a 20% loss and now go repurchase a 10% bond. But if you think about it, if he had $10,000 in the bond, he takes a 20% loss, he only has $8,000 left. So even if he gets a 10% bond, it's still paying him the same $800 a year that he was receiving from an 8% that he was getting out of a $10,000 bond. See, it's one of those heads you lose, tails we win. There's no win in it, and it's one of the main reasons you don't want to chase yield. A lot of investors, especially in low interest rate environments, go chase yield with the perception that it provides safety. In fact, what you're doing is subjecting yourself to a lot more risk, that 20% downturn that we talked about, even though it's a bond investment. In fact, if you look at the last 43 years, long-term bonds have had more negative years of returns than stocks. Isn't that interesting? Large U.S. stocks have actually had fewer years where they've lost money than long-term bonds. And we all know you've gotten a tremendous return premium for participating in equities during that time period. So ask yourself right now, if you have any bonds in your portfolio that have maturities longer than, say, 5 years, ask your advisor what type of risk you're subjecting yourself to, because unless you think interest rates are going to go lower from what they are today, which not many people think they will, you're subjecting yourself to a lot of downside risk or opportunity risk if you're forced to hold the bond all the way until maturity. So for this reason, just the one of many, bond buyers tend to be miserable people. I hope that this helps. Hope you learned something. Thanks a lot for joining me.